Where will the next pile of money be made in the precious metal sector? Both gold and silver prices have been running, and over the last 6 months, the best-in-class miners have acted as that high volatility proxy to those prices. But where is cash going to go next? We cover that in today's interview. In addition to what's different about today's silver and gold market, something that we haven't seen since the last great bull market of the late 2000s. My guest today is Sean Khunkhun, the CEO of Dolly, Varden Silver. He's got $30 million in his treasury and he's ready to go to work this summer. They've been aggressively consolidating their land package in the Golden Triangle region of British Columbia. You're going to enjoy this interview. Lots to take away from this. Here is Sean Khunkhun.
This is Jay Martin.
Okay, here I am with Sean Khunkhun of Dolly, Varden Silver. Sean, great to have you back on the show. Looking forward to this.
Thanks for having me.
So you guys have been screaming busy. The news flow coming out of Dolly, Varden Silver in May was honestly bonkers. Lots going on. I would call it bonkers. We'll dig into the details today. You can tell me what you think. Share price seems to like it though. So let's get back for anybody who's just walking into this story for the first time though. Golden Triangle, one of the most minerally endowed regions in the world when it comes to silver production. And examples of that go back to the 1920s with the Premium mine. The most profitable mine in North America, and I think, as you've mentioned, in the entire British Empire, but also many modern examples of production today, including Eskay Creek, Bruce Jack, one of the super low cost, 300,000 plus ounces per year coming out of Bruce Jack right now, and on and on. So for anybody, just what have I missed? If you're unfamiliar with the Golden Triangle, why should it be on every gold and silver investor's radar?
Yeah, and you've got the history down. It's a great area in terms of its geological significance. It's a rich area. It's in a safe jurisdiction. And because up until recently, it lacked the infrastructure. So you now have roads and power lines and you've a deep water seaport. So you've got this incredible geological gold, silver, copper mining camp. But it was essentially pretty remote up until the last few decades. So, and then, I think jurisdiction matters. I think that, where a project lies, there are projects that are in countries where, you look at what's happening in the Barrick right now in Mali, it's jurisdiction matters. So it's in Canada, it's high grade, it's big. And up until recently, it was very, very difficult to get to, which made it very expensive to operate.
Right. Yeah. Okay. Now, last 5 years with Dolly, Varden Silver, you've been consolidating your land packages in that region, beginning in 2022 with the merger with Homestake Ridge, and since then just continuing to pump cash into the ground and step out drilling and determine what's really down there. And you've recently endeavored on some more aggressive land consolidation in the Triangle. So, what is Dolly Varden today in the Triangle, Sean? What have you got, and what are you trying to prove?
Well, look, I'd like to think of like a sports analogy. We were the worst team in the league, and we've slowly, systematically over the last few years, first in the coaching staff, we've built up, we've picked the right players in the right positions, and that's led to some success on the ice. And now we're in the playoffs and we're ready to make a championship run. We want to go get that Stanley Cup. And how that's played out for Dolly Varden is we started off with a couple of small silver deposits. Two of them were past producing mines. The price of silver was $16. So it was really hard to make money in that price environment. Gold was $1,300. And we had 7,000 hectares of ground. Fast forward, we've got 100,000 hectares of the most prospective ground in the Golden Triangle. It's underexplored. And we've gone from having 2 past producing mines. We now have 5 past producing mines. Our mineral inventory has gone through the roof. We've gone from 40 million ounces of silver to over 150 million ounces silver equivalent. We've added a lot of gold into the system. We've put over 135,000 meters of drilling into the property. So we've made discoveries, we've de-risked. We've been very, very, very active. And along the way, we've picked up some incredible supportive shareholders, people like Eric Sprott, people like Hecla Mining, institutions like Fidelity. So it's been a lot of hard work. It's been a little bit of luck. It's been making opportunistic acquisitions, and it's been on the back of incredibly generous and supportive shareholders.
Now, the few acquisitions that you guys announced over the last, all of them were all stock deals, and one of them was with Hecla, who's been a shareholder of yours since I believe 2020, and this deepens the relationship. It seems like quite significantly. Can you walk me through that, Sean? The dynamic between Dolly, Varden, Silver, and Hecla, the history, and then the recent transaction.
Yeah, so there's a long history. Hecla's been a shareholder for a long time, and Hecla used to be run by Phil Baker. Phil Baker ran the company for 23 years. Hecla's a long storied company. It's been listed on the New York Stock Exchange for 135 years. And so, and the company's had incredible success. It's one of the go-to silver names on the board. And, as they think about their pipeline and their growth into the future and think about replenishing mineral inventory, they have made strategic investments into companies where they see a potential for a pipeline project. So I think the 15% they own in Dolly Varden represents their hope, their belief in the potential of our project. 12.5% was through equity investments. So that's them putting, $20-30 million of hard cash into the company's coffers so that we can go out and we can make acquisitions and we can make discoveries, drill holes, build up the team, build up the resource, de-risk the project. That last 2% that they've come in to own to go from 12.5% to just under 15% is through the divestment of a neighboring contiguous project. So they had a big prospective piece of ground that's next to us that contained a past producing silver mine called the Esperanza mine. It also contains a parallel trend called the Iliad's trend. It's a big project. And I think what our team has demonstrated is we have the ability through our knowledge of the area to make discoveries. So I think the rationale is as they're focused on their business, as they're focused on Casa Burrard and Greens Creek, Lucky Friday, Keno Hill, and all their other exploration projects, this was a way for them to increase ownership, but not have to divert funds into advancing the project. Yeah.
Okay. I get that. Now, a couple of the things you highlighted here, Sean, since taking the helm of the company, you've moved from, a resource of 40 million silver equivalent ounces to 150 million silver equivalent ounces, increased the land package from 7,000 hectares to over 100,000 hectares, including within that is 5 past producing mines. One you just referenced, Esperanza, with Hecla, and the company Dolly Varden recently got upgraded to the New York Stock Exchange in April. I didn't know Hecla had been on the NYSE for 135 years. That's fascinating. And Dolly Varden now joins that very small group of silver companies on the NYSE, which is like 9 companies, 11 companies. Do you know the number?
10 companies.
Circled it. All right, cool. So for our precious metals investors, why I wanted to bring on Sean today is because we can watch the metal prices, we can watch the price action, and I want to find proxies to those metal price performances. And I think Dolly Varden silver is about as close as a high vol proxy that you can get to the silver price. Do you think that's a fair judgment to make on Dolly Varden silver, Sean? If I were to classify your company that way to my audience, is that accurate, or am I missing something?
Well, I think it's really accurate. And we don't have to look far back, but if we just look at the last 30 days, the silver price saw a low of around $31, $32. our share price was down in Canadian dollar terms at around 350 a share. As silver has broke above, and 3250 is a very important level. 3250 is a level that silver has been, has really essentially been below since 2012, right? So, and that has acted as some major resistance. And now that we're above 3250, and this now looks like the new support level for silver. And as we start now breaking above and putting in, decade highs in the silver price, we've gone through 34, through 35. We're through 36 today for the first time in over a decade. The share price at Dolly has gone from 350. I think we traded as high as 515 yesterday. That is a big move in just a couple of dollars in the price of silver. And I was telling you about this technician that I took in a presentation in London at a Raymond James Silver Conference. And he talked about if we can get through 36, the next level of resistance is 40. So if we think about the fact that Dolly's put on $1.50 a share, would that move from 32 to 36? What would it do if it went from 36 to 40? And so, what's exciting, and the other way I look at these silver companies, and, there's 10 primary silver producers. Let's assume their average all-in sustaining cost is about $20 per silver ounce. Well, when the silver price is $25, they're making $5 on every ounce they produce. It goes to 30, they're 100% more profitable, and so on and so on. So every $5 move in silver is very, very significant. And that's where the leverage comes in. And that's where, when you look at a company like Dolly, we were trading at pennies an ounce in the ground. Today, we're trading at dollars an ounce in the ground. And if the more ounces we can get, if we can start multiplying, that by a few 100 million ounces in the ground, that's where you get a real opportunity for a silver investor, a silver speculator, somebody. And I really think that we're at a time right now where on the silver to gold ratio, there's been 3 times in history where that ratio has gone to 100 to 1, greater than 100 to 1. And we were in one of those moments in the last 30 days. Today, right now, as we speak, it's 92.5 to 1. So silver is starting to outperform gold. This is, typically every time that ratio has gone up to 100 to 1, the play has been to go long silver and silver equities, and they've bounced back quite nice. So, typically what I've witnessed in the 22 years that I've been working in the mining industry and really, acutely following precious metals and precious metals equities is first you have the price of gold move, and then there's a trickle down to the gold equities. And then you typically, after the gold price moves, you have silver move, and then you have the silver equities. And it's typically the silver equities that are, give investors the most leverage. And so this is, for anyone looking to get exposure to the space, you're looking at a historic opportunity to invest in silver at close to 100 to 1 silver to gold ratio.
Now, let me pull on the cycle of sort of money flow there, because, I think most of my audience would be attuned to that we see the pillar idea run, in this case being the price of physical gold. And then sometime after, the equities tend to catch a bid as well. And I might say, what's that time? What happens in between those two events? And maybe it's a couple quarters of earnings, right? That's what institutions need to see from the major gold producers to validate their thesis and allocate some cash. And then they do. And then maybe a similar scenario. Do you think that's accurate? And then is there a parallel situation in the silver sector, given that there's only, as you mentioned, 10 primary silver producers? It's a much smaller industry. And so you have to be a lot more creative with how you allocate capital. But, silver price now 35, 36, maybe heading to 40. Love to know as well why that number strikes you as a benchmark. But do you think it's similar in the silver sector that you need a couple quarters of earnings before big money major retail money turns its head to the equities? I mean, you look at share prices today and say, I think not. Look at First Majestic over the last week. Like, these companies are sort of getting liftoff. But what's your take, Sean?
So I want to go back a little bit. I want to go back to 2016.
Yeah. Okay.
In 2016, we had the gold price move from 1,000 to 1,400. And we had a pretty good junior market. The TSX-V had made a big move, and there was a lot of enthusiasm and a flow of funds into some speculative juniors. The problem in 2016, the difference between 2016 and 2025, is you have a new phenomenon today, which is Agnico Eagle is making $300 million a month free cash flow. Okay. They were not making $300 million even in a quarter back in 2016. So the biggest fundamental difference is, as the gold price bottomed at 1,000, and as we are now, at 3,400, in that 9-year period, okay, there's been a tremendous wealth creation. Like, you look at where some stocks were, like Franco-Nevada, I think they're around $250 a share today, in and around that ballpark. So you've had all these equities move up multiples, the big ones, and they're spitting out lots of cash. So we're in an environment now where a company like Agnico is going out and they're putting a lot of money into juniors. They put a lot of money into Continental Gold in Colombia. They bought O3 in Quebec. So because you've got this record wealth creation at the top, there's all this money that's now. So what if you go back to 2016? There was nobody competing with the speculators. The corporates were just getting their house in order. They were paying down debt. They were selling gold at $1,000 an ounce. So the difference this time, the reason why every correction has been bought quickly, is we are out of the stealth phase of initial part of the market. We are now in stage 2, which is the longest and strongest. Stage 3 is the blow off top, the euphoria. It's where the most money is made and the biggest money is made, but it's a short part of the cycle. We're in this middle inning, and this is a great time to be in the space. And that's why you have all this strength. And why I'm so confident today is we're starting to see other things happen here. For example, you go back to 2016, the US dollar was in a strengthening period, from its lows of, say, 2008 at 72 on the dollar index. And what the Dixie just did recently here is it lost 99, which is a critical element, a critical support level where it lost. And that next level should have it come down to around 96, 95. And so if you think about gold, silver, copper, these are all priced in dollars. And if we're now in an environment where it's in the interests of this new administration for a lower dollar to achieve their goals, and you just have naturally the dollar's weakening, right? You're going to have so despite the fact that we've seen a 350% move in the gold price and, a 350% move amongst the high caliber gold equities, this is really day one. This is the beginning of a new shift, and so I really think, to answer your question, we're in such a unique time where these majors are now going to play catch up quickly. They're going to secure their future mineral inventory, and you're going to see a flurry of M&A activity, and we're seeing things that look at stocks, companies like Discovery Silver, Integra, Avino, the junior producer category. There's a company in the office here, West Red Lake Gold Mines. The 6 months they've been on an absolute tear as they turn on the Madsen mine. So where the market was it was hiding out in the royalty space. Where the market has been more recently was playing the large caps, the best in class, the Agnicos, the Alamoses. In the first 6 months of the year, the place to be was the junior producer category. And what's next? It's going to be the unfunded developers. The unfunded developers, Agnico and First Majestic are trading at 2 times net asset value, yet there's unfunded developers that are trading at 0.2 times net asset value. So for those who are looking for value, they're going to come down and start positioning in that tier. And so, I think of a company like Dolly, where we've got this large resource, it's high grade, it's in a safe jurisdiction, and we've played a lot of catch up in the last 2 weeks in terms of share price, but we're still lower today than where we were in October. And so I think that there's still a tremendous opportunity. And then considering company specific events like the fact that we were able to go from 15,000 hectares to 100,000 on 2% dilution. So the fact that we are taking advantage of an even lower tier in the market, the deals we did with the sub juniors, the nano caps, where we picked up projects that were once valued at $100 million and we bought them for $1 million, right? I'll give you one example. Porter, Idaho, past producing the highest grade silver mine in the Golden Triangle. We bought it for 8.5 cents an ounce in the ground. And we're trading at over $2 an ounce in the ground. That's an accretive deal. So that has been how we've built the company. It's been on looking for accretive opportunities where we can use our relative strength and to grow.
You mentioned this unique point in the market where the majors are spitting out so much cash. Agnico, $300 million in free cash per month. And simultaneously, them and their peers are all going to be looking to invest in their future pipeline. And you referenced Continental and O3 transactions by Agnico, Hecla recently divesting from an asset and increasing their ownership of Dolly, Varden. Similar strategy, right? They're investing in their future pipeline. And in some cases, using their, record earnings to do so. In your case, you can use your shares as that currency. And given the performance of the stock, it allows you to do so with very little dilution, which you've demonstrated. I wanted to ask you a question. You referenced the time in the market is primed for unfunded developers. And could you just wrap that in a bit of a definition for my audience, Sean? How would you quantify an unfunded developer?
So I think when I look at the market, you've got your producers, right? And then you can go in and you could say you got your senior producers, your mid-tier producers, your junior producers, your emerging producers, right? There's probably 4 categories within the producer space. And then, at the bottom end of the space, you've got your early stage grassroots exploration. And then you're moving up to advanced exploration. Maybe the company's got a resource, and so you got your early stage exploration, your advanced exploration, and then you've got your developer category, right? So that's in between exploration and production. You've got your developer category, right? So if you're a single asset company and you're a developer, you're either funded or you're unfunded, right? In the case of Skeena Resources, that's a funded developer. They've got project financing in place. They've got all the capital to take SK Creek. So that's a funded developer. And they're not trading at 0.2 times net asset value. They've got about $2 billion market cap because there's no financing risk. Okay. But the unfunded developer category is a company that has got a project where it's got a advanced economic study, but what they lack is the funding to take it into production. And so, unfortunately, in the environment we're in for the last 10 years, companies have had to go out at credit card interest rates to build their projects. And so let's think about this, Jay. Gold was $1,000, and I'm borrowing in the high teens to build, right? And so how many new gold mines are coming online in the next little while? Very, very few. And then if you go even further, so that's your unfunded developer category. And the biggest challenge is, let's say you have a really big, robust project. And let's say, it requires $1 billion to build. And you're trading at a 20 or 30 or 40 or $50 million market cap. The market's looking at you going, you don't have the means to build, right? And so, sort of the math on that is about 3 to 1. So for companies that have the $1 billion CapEx, you want to see at least a $300 million valuation, because then you can, through maybe a convert, maybe a royalty sale, take on a little bit of debt, tag the equity markets for a little bit of that capital. That's a digestible build. So, if you go back to that market when we were $1,000, the projects that were looked at were small projects, extremely high grade, where the CapEx was tiny. The sweet spot in the market we were in was sub $100 million CapEx projects. And then if you think about the height of the last cycle, the market was looking at these really, really low-grade systems where there were big CapExes because money was awash in the space. It was the best mine finance market. And it's why the industry went from $1 billion of debt to 40 billion for a very, very small industry. We increased our debt levels by 40 times because the thinking was the gold price was moving from 300 to 1900 and with no end in sight.
Yeah, I like how you walked through that. And, the journey of a mining company from exploration to production is like answering a bunch of unanswered questions effectively along the way. First of all, is there something down there? Secondly, how big is it? Third, is it economic? Fourth, can we fund it? Right? Like that's actually a major hurdle and one of the least discussed. And I like how you put that in context. So that's what Sean's referring to, guys, when he talks about the next leg in the sort of capital trickle, right? We've watched the best in class miners catch a bid, hit 52-week highs, if not better. Mid tiers and junior producers are now also performing extraordinarily well in many cases. And the next category of exploration development mining companies to catch that bid, likely given market cycles of the past, will be those development companies, the unfunded development companies. So not the Skeena. And if you're curious about where Skeena's at, Walter Coles gave a masterclass in mine finance on our channel a few months ago. I'll pop a link down there, but they secured $1 billion to bring the Eskay Creek mine back into production. And he walks through the just various, terms attached to different tranches of that capital. But that's the category that Sean's looking at now is the unfunded development. That's what you're referring to.
Yeah.
Yeah.
And I just want to say one other point, Jay. What we have to really think about is like in the stock market, buying begets buying, selling begets selling. And it's even more exaggerated in the last 15 years with the rise of the algos, the quants. And, as momentum is such a big part. And for the first time in our industry, we now have positive momentum. But the point I really want to highlight here is if you go back to 2016, when the gold price was 1,000, nobody was making money in the space. Okay. Yeah. And I remember there was a takeover deal. It was like the first of the era. It was a little junior called Kaminak that Goldcorp bought for about $500 million in 2016. And it was like, yes, finally, people are making money. Well, that's happening all the time. There's a mine in BC that just turned on, the Blackwater project that Artemis has, right? And if you think about the investors, there's a group here, BD Capital, that put a lot of money into that project. And it's been a huge success. Artemis has got about a $5 billion market cap today. My point is, the more Artemises that we have, the more Great Bears, the more Kaminaks, the more O3s. The industry is working, it's winning, and that's why capital's starting to come in. And it's the snowball effect. And we now have, for the first time, momentum in the space. And it's concentrated right now at the top of the space, but we're starting to see it move down. And what's exciting, and I think it's Rick Rule who maybe coined this. It's like pouring a whiskey bottle in a shot glass. Like, there's not enough places to house the capital when it comes in, and that's why, in the case of Dolly or in the case of First Majestic, when that capital comes in, our share prices go.
Now, let me just ask you, because you've always got an interesting take on this. It's easier in hindsight to reflect on the sort of catalyst for price action. Why, Sean, why are precious metals catching such a strong bid today? There's some obvious answers that you might point to, but I want to get your take. What's catching your attention is the rationale.
Well, look, I think this is a story that began a long time ago. I think it began in 1971, right? And I think it's, gold was essentially, it wasn't a free market, right? And not a lot of people know that, especially a lot of young people. And so gold was set at $35 an ounce. And unfortunately, and the US dollar was the world's reserve currency. And when the US said we have to free gold because otherwise we're going to lose it all, you had Charles de Gaulle out of France saying, I'll take as much gold as I can at $35. So Nixon said, no, we're going to temporarily close that window. So really, you need to go back to 1971 to say why. And if you look at what gold did, it ran to $200 in 4 years. It went from 35 to 200 the first time it was freed. And then it corrected, and it corrected to 100, okay, in 76. And then from 76 to 81, it went to $887. Now, if you think about this, Jay, for 2 decades, gold lived at about $350 an ounce, which is 10 times higher than the $35 it was pegged at. Okay. Mm-hmm. What did it do? It ran to $2,000, $1,900, and it pulled back to $1,000. If you put up that chart from 1971 to 1976, it looks like what gold did from 2000 to 2016. It was the exact same move. It was just, magnitudes of 10 times more. Mm-hmm. And so, why? Well, look, it's, central banks, governments, deficits, debt. That's the why. And that's not ending. And so, I just think that, central banks and those who are high net worth are buying gold to protect themselves. It's real money. And that's the why. The why silver now, that's a much more complicated discussion. But I think that historically silver was always money, and where it's sort of come off that track a little bit is industries just used it more. And so it's traded more like an industrial metal than it is money. However, that long history of money, plus the fact that it's got an industrial use, I think actually makes silver more valuable today. And we'll see how that plays out. We'll see if I'm right or I'm wrong. But we have seen like people are talking about the copper deficits that are going to come. And people are talking about getting excited about copper because in 7 years, copper will be in deficit, right? Robert Friedland, one of the most successful, mining entrepreneurs of all time, is his number one focus is copper. But what I'm saying to the world is, I'm not excited about silver because 7 years from now it's going to be in deficit. I'm excited about silver today because for the last 5 years, it's already in deficit and the price has already doubled and it's going to double again. So what I'm saying is this is happening today, plus the 5,000-year history as money. And we're starting to see those same high net worth individuals, and we're even starting to see central banks getting into silver. So, and I really think that what drives gold equities is Western buyers, right? The reason we hadn't seen, the gold equities really move is the West hadn't been buying gold equities. Now the West is in the gold trade. The West is now buying gold equities. And guess what? The West will be buying silver. And the East has been already buying a lot of silver. The biggest buyers have been China and India. So no, I just think we're starting to see it now. We're starting to see that 100-to-1 ratio. It's 92-to-1. I bet you if you have me on in a couple of months, we're probably talking about 80-to-1, 75-to-1.
Let's do it. So, just to recap some of our discussion, you used to say this and you still do, I suppose, silver is money, Dolly Varden is silver, and that quote is why I began thinking about Dolly Varden as, proxy, a high vol proxy to the silver price. And, I think your share price recently has validated that opinion. Silver's doubled. It might double again. You have consolidated one of the most, minerally rich and endowed regions in the world in the Golden Triangle, now over 100,000 hectares of property. What can prospective shareholders expect from Dolly Varden, Sean? I know you've just begun a drill program this summer. I want to conclude this interview with expectations of news flow. You had a crazy busy May, lots of land consolidation, increase in your land packages, and now you got 4 rigs, I believe, maybe more, 4 rigs up there running this summer. What can prospective shareholders expect from you over the next few months?
Well, and one thing I want to touch on here is in the future, you won't be able to buy prospectivity. You won't be able to get optionality. What I did by securing that ground in May, when we had a 100-to-1 ratio, when nobody cared about the sector, was I picked up things that, you won't be able to get in the future at these prices, number one. Number two, what we're doing today is we have 4 rigs turning on our ground. We have 4 rigs at the Wolf deposit. So what investors can expect is for us to leverage our $30 million treasury into exploration, into growth. And ultimately what my goal is there is a mill in the area. It's a 3,000 ton per day mill. It's currently on care and maintenance. All these past producing deposits and our new discoveries, our new deposits, the past producing mines and our new deposits, there's no reason they can't in the future potentially fill that hungry mill.
Yeah, right. That's the goal. Okay. I love that. 30 mil in the treasury to put to work. Recently we did an episode just about where we're at in this cycle. And I said, if you're ready to start looking at the earlier stage projects, it's so important that you find those that already have a resource, that have been able to raise capital in good markets and bad, are presently putting that capital into the ground to expand on what they know. And they're in a jurisdiction that's got a history of success. And right now, I think that's the sweet spot for the industry. And if you want to get more speculative than that, by all means, not me at this point, you don't need to. Dolly Varden ticks all 4 of those boxes, as you just outlined. Sean, it's been great chatting with you, man. I always love your perspective. Thanks for coming back on the show.
Thanks for having me on, Jay.
All right.